Hi everybody, welcome to today's video. We're going to be talking about the markets in 2022. The first 5 months of the year have been negative. It has a lot of people worried, asking a lot of questions around how does this impact my retirement? Will I be able to retire? When are the markets going to actually be positive? I'm going to dig right into this and explain to you why this market is negative, why it's actually doing what it's doing, and what you can do about it, how you can protect your assets, and actually put yourself in a position to take advantage of some of the opportunities. If you're new to the channel, hi everybody, my name is David. I'm an active advisor working with clients right across Canada, business owners, families, and individuals. I make educational videos absolutely for your benefit. There's no selling in this channel. I'm not going to be promoting, and I never promote any one particular company or product. I just simply tell you about what is good and what is bad about individual products. You might hear me say from time to time, now's the time to do something, but that's just about as high as I'm ever going to get in terms of pushing or selling on you. This is designed to give you information, knowledge, and that knowledge is going to help you make better decisions, and those better decisions lead to better outcomes. 100%, that's the mission that I have with this channel. Okay, this is going to be a lot of content. I'm going to blast through this as fast as I can because there's so much detail I have for you. I hope you appreciate it, but I'm just going to like lightning speed get through this. So you ready? If you have any questions or comments, put them below. I'll get to them just as soon as I can. But without further ado, let's get after it. Okay, I'm going to give you a brief economics lessons. This is an economic cycle or business cycle. Talks about, and this is important because we want to understand why the markets are behaving the way they are. We've got expansion. This is the area of growth. We've been through the longest time of growth, expansion in recorded history since we've been recording financial data. And it's been a benefit to us. You've seen all of your assets go up. Your homes, all your investment accounts have all gone up dramatically over the last 20 years, basically. Even though there have been some bumps in the road, those prices have gone up dramatically. Eventually get to a peak, and the peak is, high prices, relatively high inflation as compared to the average, a low unemployment rate, and basically a high demand for products and services. That is the peak, and some people would be asking right now, are we at the peak? I think we're past the peak. That's my own belief. I think we're past the peak. But we're certainly not in a recession. A recession is typically, you'll see a low demand for products and services, prices on the way down. Inflation can kind of creep up, but inflation is already high anyway, but it has very little to do with are we in a recession. And so we're not in a recession. I know the governments around the world are worried about going into a recession. That's why they're raising interest rates, but I don't think we're there. And part of the idea of inflation going up so high, I'm going to get into that in the next couple of slides. So that's a little brief explanation, and that's going to make sense to you as we work through these slides. Okay, here we are with this expansion, this explosive growth. There is COVID-19. Markets were going up actually really well. COVID-19, and all the markets sold off dramatically. You remember why, and rightly so, we're all very worried. But look what happened also. Markets, despite panic, like pandemonium across the world, everybody was at home, the markets went up like a rocket. How is that possible? Let me ask you a question. If we're all being forced to stay at home, businesses closed, no shopping, no travel, supply constraints, how can markets skyrocket? Just ask yourself that question. If you can't spend your money, you can't leave the country, you can't enjoy your money other than putting it in real estate and in other investments, but you actually can't spend money on companies that are in the stock market, because typically we have to spend money in the stock market to allow those companies to go up. How is it that the market didn't go negative or flat? Does it make any sense to you? It shouldn't, but this is why. It's called quantitative easing. Government, the Federal Reserve, and I'll just read this to you, is the central bank, that's a Federal Reserve, purchasing long-term securities to increase the money supply, to encourage lending and investment, adds new money to the economy, but it also lowers interest rates. This is one of the biggest things they were trying to do, lower interest rates. So what happens when you add money to the economy and you lower interest rates? It elevates asset prices. That's why we're in this people call it a bubble, but that's why everything's inflated. That's why you saw in that slide the market taking off. Here is what's happened in the last 2 years. The Federal Reserve has borrowed $4.5 trillion over the last 2 years and put that directly into the market. Some of it went overseas, but nonetheless, you've got, look at this line, the blue line, that's the Federal Reserve adding money to the economy. The red line is the S&P 500 rising despite tough economic conditions. Look at 2020, straight up. That is basically the Federal Reserve saying, if you can't go to work and you've lost your job, no problem, we've got some money coming for you every month. If you're an employer and you have to close your doors temporarily, no problem, we have loans to keep your business operating. If you've got a problem, we've got the solution. Here's the money. And that's them injecting money to the market. Ordinarily, if businesses closed and people were unemployed, that we should go into a recession. And you see that gray line? That's actually, that vertical gray line is actually a recession. You see the one in 2008, the worldwide economic collapse, we went into a recession. We went into it was like a hiccup in 2020. And why didn't we go into this long, drawn out recession? Because the governments around the world decided we're going to spend our way through a recession. Nobody's going to suffer. And that's why you see that S&P 500 line going up so dramatically, because the government, the Federal Reserve, was actually supporting the economy. They were funding the economy. So all of the price increases in homes, price increases in your portfolios, here's the Canadian market, $1.1 trillion. All that price increase was artificial. The government is artificially keeping it. And now what they're doing is they're saying, we're not going to do that anymore. And that's what's causing the market to drop. And when you flush the market with a lot of money and lower interest rates, what happens? Well, inflation creeps in. Here's the United States. United States probably tomorrow, Wednesday, probably going to be around 8% inflation rate. Here's Canada, 5.64. They're hoping that it's going to go down to 2.5%. But that is the nature of just economics. It's not something unusual going on. This is the saying is, when you pray for rain, you got to deal with the mud. The mud is inflation right now. The rain was let it rain, money, right? Money being injected into the economy, and this is the inflation that we have to deal with. So now the opposite is happening. Governments around the world, especially the United States and Canada, are saying we're not going to support the economy to the extent that we have. We're actually going to raise interest rates to try to get inflation to come down, and we're going to actually stop funding the economy and allow it to stand on its own 2 feet. Well, first of all, anybody that's thinking about that gets worried and go, what are you talking about? We don't know how stable the economy is right now because you've been supporting it. We don't know how stable it is. So that is that feeling of anxiety and worried about will we immediately go into recession? I don't see that happening. I don't see the governments allowing that to happen. The reason why we have inflation is this paragraph here, this extraordinary demand for products and services. We've been in lockdowns. We haven't been going out. We haven't been able to shop. So all of a sudden, for 2 years, we've been banking all this money and just putting into investment accounts. And now we have the opportunity to spend our money. That's this extraordinary demand. The problem is we don't have access to all the things we want to buy because we have a supply constraint problem driven by COVID. And so once that supply issue dissipates, you'll see the prices will begin to come down. Inflation will come down. So it's going to take time to work through this. And that's the whole message of what's going on with the markets right now. It's just going to take time to work through all of these issues. And once it does, the market should move forward normally. And so the message, I guess, is this year 2022, try to be patient, try to understand that it's not a symptom of companies operating poorly. It's just a symptom of what COVID did to the world and how to work through that. Okay, now let's talk about the Federal Reserve. You're going to hear words like tapering or unwinding their balance sheet. What this really means is tapering is slowly removing the monetary stimulus from the Federal Reserve that they've been providing to the economy. That's what's happening. So expect to see interest rates continue to go up to tamper down inflation, and the Federal Reserve in Canada and the United States to allow the economy to kind of roll out on its own 2 feet like a baby on training wheels to see how well it goes through the issues that we're dealing with now. But because of that, that creates market volatility. And that market volatility is hard to deal with. One day it's up, one day it's down. But just keep in mind that that's not going to be forever. That's only going to be a short period of your entire investment cycle. You know, all this creates uncertainty, and the market doesn't like uncertainty, and that is why we're seeing this upside down. So let's now dig into what you can do. There's 6 things you can do. Some are portfolio allocation, some are be aware of these things coming down, so looking forward a little bit, and the other is going to be what you can do to take advantage of. Okay, so let's dig into this, and I'll blast through this as fast as we can. Okay, you want to review your financial plan. I put this in every video, but specifically there's an area in your financial plan I want you to review. I know a financial plan is seeing the outcome of your planning decisions before you commit to them. The area that I want you to focus in on your financial plan is cash flow. So people ask me this question quite a bit over this last few months, and that is, how is the market affecting my cash flow, or how well or how much will this negative returns affect my cash flow in the future? So your financial plan has that already in there. All you have to do is make sure that it's up to date with your current data, meaning balances, and it'll actually tell you what your cash flow will look like. That's the number one place to look for right away. The next is work on yourself and the way that you, like the anxiety that you have around all the noise, right? The news is doing a really good job of making everybody crazy about what's going on and selling fear. What you want to do is you want to take that away and put in its place facts about your actual current situation. How much money do you have? When you're going to retire? What's your cash flow? How much income are you going to have in retirement? Because facts will foster confidence. And I think that's so important. If you're near retirement or in retirement, you want to be confident about the longevity of your financial situation. The next is just make some minor adjustments to your portfolio. Hopefully you don't have a bad portfolio and it's big adjustments, but minor adjustments. During times of rising interest rates, you want to move your fixed income, so your bond durations, you want to shorten them because they're less susceptible to changes in interest rates. Let's look at some of the sectors that you might want to consider for your portfolios. You call this recession proof, or you call this just being more defensive. Let's go into this. Financials. Banks make money in all economic cycles, so it should be a staple in your portfolio no matter where we are in the cycle. Consumer staples, again, another staple. It's a staple. You got to have what you have to have. And companies that provide you with the necessities of life, this is where you're going to want to put some of your money. Energy prices always go up when when interest rates go up. That pushes energy prices high. And specifically whenever there's a geopolitical event, that'll also push energy prices high. Materials are companies that supply raw materials to other companies to produce things like cars and steel for bridges and building buildings. This is important. Materials their margins tend to get better during times of rising interest rates. So that would be a good place for you to put your money. Real estate prices, I don't think, are going to drop. Real estate sales have gone down about more than 25%. I'm not a real estate agent, but they've gone down by more than 25%, largely because interest rates are going up and it's pushed some of the people out of the market, but prices haven't really dropped. So I don't think you're going to see that. Anybody that has access to capital right now is going to make more money in the real estate market. It's just that simple. Rental prices will go up because more people will be forced to stay in rental properties longer. One thing I will say about the energy prices, a little caveat, and let's hope so that the Russia-Ukraine war stops, we will see weakness in energy, and you'll see that energy prices should come down, and that will begin to lower inflation as well. Increase your savings. Here are some things you should be doing or be aware of over the next 6 to 8 months, okay? Mortgage renewal prices will be higher. You know, interest rates are going up. If you bought a house 3 to 4 years ago, you're going to be renewing into a higher mortgage interest rate. So you got to be thinking ahead about what your plan is to absorb the extra costs that you're going to be putting into your mortgage. Talk to your mortgage broker about how you're going to be able to do that. The next is the probability of a recession. If there is, in your mind, a recession on the horizon, then you have to be thinking about limiting the large capital expenditures that you're going to be doing and maybe pushing those off for a little bit. You may want to look at your budget and say, where are we spending a lot of money because we've had a lot of money recently? Where do we need to just sort and tighten it up a little bit and start conserving some of your cash for the times that if we do go in a recession, you'll have cash available, not just for weathering the storm, but also remember what I said in the beginning, recession prices go down. If you're sitting on cash, great time for you to jump into the market and buy things that are going to be a lower price, okay? Costs are going up. Costs are going to remain high. Inflation is not going to change overnight. It's going to take a while for inflation to come down, so expect prices to remain high. And also the supply chain is not going to be improving that quickly. So I also expect food prices will go higher. And also, here's another one for you. Christmas is around the corner. 4 months from now, 5 months from now, you're all going to be shopping for Christmas gifts. Well, people that observe Christmas. And I tried to buy, just as a side note, I tried to buy a battery adapter for my MacBook Pro in the Apple store yesterday, and they said it would be delivered to my house in the middle of July. And we're in the middle of May. So if you're thinking that we're going to have an abundance of products for us to purchase for Christmas, I'm really doubting that. And you may want to consider ordering things now or being on the list to get things in when they do arrive, because I just think that it's going to be difficult for shopping this year. So get ahead of it and order your gifts now and find a place in your house where you're going to hide them from everybody. Okay, communication. Communication is really important. When things are going well, people like, oh, I don't need to talk to an advisor. I'm making so much money. And then when things are going bad, everybody goes quiet. Man, this is the time where you got to talk to your advisor. So get on the phone, get in a Zoom call, and communicate more. Talk to them about your concerns. Tell them, how you're feeling, because that is evidence to an advisor that there's some areas that they need to go over again and give you some reassurance. So bug your advisors, get on the phone with them more often than you would normally, and just put all of your concerns aside so that you can go forward throughout the summer and the fall and know that everything is fine with your portfolio. Now, the last thing is lower values are attractive. If you're new to the market, happy day, everything is on sale. If you're commuting your pension and you're now going to be dropping a couple million into the market, extremely happy day, because everything is on sale, as I've mentioned to you in the slides before about the markets being down. So now is an awesome time if you've got cash to drop it into the market, because you've got, remember, if you're retiring now, you've got 30 plus years, hopefully, of markets that you have to manage, and you're buying into a market that is dropped right now. And so I think it's a great time for you if you're investing today. I want to end every session by telling you that we take care of your wealth management so you can take care of what's most important to you. If you have any questions about today's video, please put your comments below. I'm happy to answer them. Even just your comments, I want to hear what you're thinking. Other people want to hear your comments as well. Helps them kind of formulate their own decisions as well. If you have any questions, feel welcome to reach out to me. I think there's about 5 million ways to get in contact with me. I appreciate your time in watching this video today, and I look forward to seeing you in the next video. Thanks very much, and take care.